A group gathers at the steps of the Vancouver Art Gallery, opposing the United States operation in Venezuela.
More than 300 billion barrels of proven crude oil, a naval seizure in the Caribbean, active sanctions, and a United States military presence positioned just offshore. This is no longer a distant geopolitical dispute. It is a live trade war over energy that may determine who controls the world's most valuable heavy oil supply and who gets pushed out of the market entirely. It is a numbers-driven supply chain reality. And by the end of this analysis, one overlooked statistic will expose why Canada may be far more vulnerable in this trade war than most officials are willing to admit. Stay to the end, because the final comparison reveals a shock few in Ottawa or Washington are openly discussing. At the center of this escalation sits a set of numbers that energy markets cannot ignore. Venezuela holds more than 300 billion barrels of proven oil reserves, the largest officially recorded total in the world. Yet current production remains below 500,000 barrels per day, despite technical capacity estimates ranging between 2 million and 4 million barrels per day if sanctions and operational constraints were eased. That gap alone represents one of the largest untapped supply shocks in the modern energy system. The United States refining network explains why this matters. Along the Gulf Coast, more than 9 million barrels per day of refining capacity is configured to process heavy and extra heavy crude. These facilities were originally designed to handle oil grades nearly identical to those produced in Venezuela and Canada. For decades, Canadian heavy crude filled much of that demand, moving south through pipelines into refineries in Texas, Louisiana, and the Midwest. However, logistics and cost structures are shifting. Venezuelan heavy crude sits significantly closer to tidewater. In the Orinoco Belt, oil can be extracted with less energy input due to higher ambient temperatures, reducing per barrel production costs. Transportation from Venezuelan ports to Gulf Coast refineries is measured in days, not weeks, and avoids long inland pipeline tolls entirely. These advantages translate directly into lower delivered costs for refiners operating under tight margins. Meanwhile, Canadian producers face a different arithmetic. Western Canadian heavy oil has recently traded at a steep discount to West Texas Intermediate benchmarks, with differentials exceeding $20 per barrel during periods of congestion and weak demand. Pipeline transportation alone can exceed $10 per barrel before any refining margin is realized. When refinery buyers have alternative heavy crude sources, pricing power shifts rapidly away from Canada. This is where the trade war dimension becomes unavoidable. Sanctions, selective enforcement, and strategic licensing determine which barrels move and which remain stranded. Tariffs on steel, aluminum, and energy inputs further raise costs for Canadian operations, while American refiners benefit from proximity and policy alignment. Taken together, the numbers point to a stark conclusion. Even a partial reactivation of Venezuelan production could displace hundreds of thousands of barrels per day of Canadian crude from its primary export market. And the next data point reveals why this displacement would not be temporary, but structural, reshaping North American energy flows for years to come. The first measurable impact appears in pricing, and the numbers are already unforgiving. Western Canadian Select Heavy Crude has historically traded at a discount to West Texas Intermediate, but during periods of refinery oversupply, that discount has widened beyond $20 per barrel. When Venezuelan heavy oil re-enters the same refining system, even in limited volumes, analysts estimate additional downward pressure of $5 to $10 per barrel on Canadian grades. For producers operating near break-even, that difference determines whether wells remain active or are shut in. This pricing dynamic directly affects employment. Canada's oil and gas sector supports hundreds of thousands of direct and indirect jobs concentrated in Alberta and extending through manufacturing, transportation, and professional services nationwide. A sustained price decline reduces capital spending first, followed by workforce reductions. During previous downturns, every $1 billion reduction in upstream investment corresponded with thousands of job losses across the supply chain. The risk is not a short-term cycle, but a prolonged period of suppressed investment caused by structural competition from cheaper, heavy crude. Provincial finances are also exposed. Royalty revenues tied to oil prices fund public services, infrastructure, and social programs. A sustained drop of even $5 per barrel across total production volumes translates into billions of dollars in lost public revenue annually. These losses cascade into budget constraints, delayed projects, and increased fiscal pressure at both provincial and federal levels. Consumers eventually feel the effects as well. Lower crude prices do not necessarily translate into lower fuel costs when refining margins, transportation fees, and tariffs on inputs rise simultaneously. Instead, households face a more complex outcome: economic uncertainty, weaker labor markets, and reduced government capacity to absorb shocks. The energy sector's volatility becomes a broader social issue, not just an industry concern. Yet pricing and employment are only the first layer of exposure. The deeper risk lies in how quickly market access itself can disappear, a factor that becomes clear when logistics and infrastructure are examined more closely. Canada's oil export system remains heavily dependent on the United States. More than 90% of Canadian crude exports flow south, tied to a pipeline network that delivers directly into American refineries. This dependence leaves producers vulnerable to policy shifts, regulatory decisions, and strategic preferences beyond Canada's control. When alternative supplies become available to those same refineries, Canada has limited leverage to respond. Pipeline economics illustrate the constraint. Transporting oil to tidewater through Western routes can add more than $10 per barrel in tolls alone. At oil prices near $45 per barrel, that cost absorbs a disproportionate share of revenue. If global heavy crude markets become oversupplied due to Venezuelan reentry, exporting beyond North America becomes economically marginal for many producers. Infrastructure exists, but the price signals discourage use. This vulnerability is magnified by the broader trade war environment. Energy markets no longer operate in isolation from geopolitics. Sanctions, selective licensing, and trade enforcement increasingly shape which barrels reach refineries. For Canada, a close ally yet not immune to tariffs, this creates an uncomfortable reality. Alignment does not guarantee priority. International investors recognize this risk. Capital allocation decisions now factor in geopolitical exposure alongside commodity prices. Projects with uncertain market access face higher financing costs or are deferred altogether. Over time, this erodes Canada's competitiveness relative to regions with easier access to tidewater and fewer policy barriers. The result is a slow-moving structural shift rather than a sudden collapse. Market share declines incrementally, investment migrates elsewhere, and dependency deepens. By the time the impact becomes visible in national statistics, reversing course becomes far more difficult. And this leads to the next critical question: whether the strategic choices being made in Washington ultimately strengthen or weaken its closest energy partner. The answer lies in the international calculus now shaping refinery demand and alliance economics, and the next section reveals why that calculus may carry unexpected consequences for the United States itself. From a Washington perspective, the numbers initially appear compelling. The United States consumes roughly 20 million barrels of oil per day, while maintaining refining capacity that exceeds 18 million barrels per day, much of it concentrated along the Gulf Coast. A significant share of that capacity is optimized for heavy and extra-heavy crude. Securing a stable, low-cost source of such oil is therefore not a political preference, but a structural requirement. Venezuelan crude offers precisely that. Its proximity to the Gulf Coast reduces transportation costs by several dollars per barrel compared with inland North American supplies. Production costs in the Orinoco region are materially lower than oil sands extraction, largely due to geology and climate. For refiners operating on thin margins, these savings compound quickly. Even a $3 to $5 per barrel advantage translates into hundreds of millions of dollars annually across large refining complexes. In a prolonged trade war environment, access reliability matters as much as price. Sanctions regimes and selective licensing allow Washington to influence who benefits from Venezuelan output. This creates leverage not only over Caracas, but also over global energy markets. For the United States, this leverage supports three immediate objectives: protecting refinery profitability, moderating domestic fuel price volatility, and reinforcing strategic control over critical energy flows. There is also a geopolitical dimension. By shaping the conditions under which Venezuelan oil reaches the market, Washington signals its ability to enforce supply discipline beyond formal trade agreements. In a world where energy security increasingly intersects with national security, such signaling carries weight. It reassures domestic industries that supply disruptions can be mitigated through policy tools rather than market forces alone. However, these short-term gains obscure a growing contradiction. The same strategy that strengthens American control over supply chains also introduces new strains into long-standing alliances, particularly with Canada, a partner whose energy system is deeply integrated with that of the United States. Canada has historically been the most reliable external supplier of crude oil to the United States, accounting for more than half of all American oil imports in recent years. This relationship has been built on predictability, regulatory alignment, and shared infrastructure. When Canadian oil loses priority access to refineries due to alternative heavy crude supplies, the economic impact extends beyond pricing into trust and long-term cooperation. International observers are already recalibrating. Asian and European markets view the situation as further evidence that energy trade is increasingly shaped by power rather than neutrality. For producers outside North America, the message is clear. Access depends on alignment, not just contracts. This perception accelerates diversification efforts, with countries seeking suppliers and routes that reduce exposure to unilateral policy shifts. The risk for the United States is subtle but significant. Over-reliance on geopolitical leverage can discourage investment from allied producers who value stability over short-term margins. Canadian firms, facing reduced access and lower realized prices, may scale back long-term projects that once supported continental energy security. Over time, this reduces supply resilience rather than strengthening it. There is also a domestic political dimension. Energy-intensive regions within the United States depend on cross-border supply chains that support employment, manufacturing, and logistics. Disruptions or reconfigurations driven by external strategy can produce uneven regional impacts, complicating internal economic management. Within the broader trade war, energy decisions rarely remain isolated. Tariffs imposed in one sector often invite retaliation or adjustment in another. A strategy that sidelines Canadian crude today could reappear in negotiations over metals, agriculture, or advanced manufacturing tomorrow. Each instance compounds uncertainty and raises the cost of cooperation. The international system is responding accordingly. Long-term contracts are being reconsidered, alternative routes explored, and investment risk premiums adjusted. What appears as a tactical advantage for Washington may therefore carry strategic costs that unfold gradually beyond electoral cycles or quarterly earnings reports. This brings the analysis to its most consequential question: whether the current trajectory represents a sustainable long-term strategy or a short-term optimization that undermines the very partnerships the United States relies on to compete in an increasingly fragmented global economy. The final section examines the long-range scenarios now taking shape and why the next few decisions could lock in outcomes that are difficult to reverse. Looking beyond immediate market reactions, three long-term strategic scenarios are now emerging, each with sharply different consequences for the trade war, the United States, and Canada. The first scenario is consolidation of control. Under this outcome, Venezuelan production gradually increases under conditions that favor American commercial and strategic interests. Even a return to 1.5 to 2 million barrels per day would fundamentally alter heavy crude dynamics in North America. Gulf Coast refineries would have a closer, cheaper, and politically managed supply source. Canadian heavy oil would remain technically competitive, but structurally disadvantaged. Over time, this would reduce Canadian export volumes, compress margins, and weaken investment incentives across the oil sands. The second scenario is diversification under pressure. Faced with declining access to its primary market, Canada accelerates efforts to reach non-United States buyers through Pacific tidewater. However, this path is constrained by economics. When global heavy crude prices hover near $40 to $50 per barrel, transportation tolls exceeding $10 per barrel consume a disproportionate share of revenue. Projects remain technically feasible but financially fragile. In this environment, diversification becomes a defensive move rather than a growth strategy. The third scenario is negotiated recalibration. Recognizing the long-term risks of alienating its most reliable supplier, Washington could rebalance priorities, maintaining Canadian crude as a core component of refinery supply while managing Venezuelan flows more cautiously. This would stabilize prices and investment expectations, but reduce short-term leverage. In a fragmented global economy, such restraint is increasingly rare. What makes these scenarios critical is that once infrastructure investment decisions are delayed or canceled, they are rarely reversed. Capital that leaves the sector does not return quickly, and skilled labor migrates permanently. The choices made during this phase of the trade war will therefore echo for decades, not years. There is, however, one risk often missing from public discussion. Energy markets are not isolated from political legitimacy. If Venezuelan production expands rapidly under contested conditions, long-term stability becomes uncertain. History shows that production surges driven by external control often face operational disruptions, infrastructure degradation, and political backlash over time. These risks are not theoretical. They are embedded in every reserve estimate and investment forecast. For the United States, this introduces a paradox. Short-term access gains may come at the expense of long-term supply reliability. Canadian oil, by contrast, offers lower political risk, stronger regulatory transparency, and predictable output. When geopolitical shocks occur, reliability often outweighs cost advantages measured in a few dollars per barrel. This is the quiet dilemma beneath the headlines. The trade war logic prioritizes leverage and cost efficiency, but energy security ultimately depends on trust and durability. If Washington leans too heavily on tactical advantage, it risks weakening the very resilience it seeks to protect. The final calculation, therefore, is not purely economic, it is strategic. And it raises a question that has not yet been openly addressed, whether the current trajectory reflects a deliberate long-term plan or a series of short-term decisions that collectively undermine North American energy stability. The answer determines not only who wins this phase of the trade war, but who absorbs the consequences when the next shock arrives. The seizure of Venezuelan oil, the tightening of sanctions, and the shifting flow of heavy crude are not isolated events. Together, they form a coherent pattern within a broader trade war that increasingly defines how energy, economics, and national interest intersect. For the United States, the strategy offers near-term leverage and supply control. For Canada, it exposes a structural vulnerability rooted in market concentration and infrastructure dependence. The numbers are unambiguous. Small shifts in refinery preference can translate into billions of dollars in lost revenue, thousands of jobs at risk, and reduced public capacity to manage future downturns. Tariffs, logistics, and policy alignment now matter as much as geology or production efficiency. In this environment, assumptions built on past cooperation no longer provide sufficient protection. What remains unresolved is whether this approach ultimately strengthens North American energy security or quietly erodes it. Does prioritizing short-term control over diversified, trusted supply make the system more resilient or more fragile? That is the question policymakers, investors, and workers alike must confront. Is this a bold strategy or a risky mistake for the United States? For more fact-based global analysis on trade, tariffs, and geopolitical risk, subscribe and stay informed.